And we're going to be moving on to our next session right now. Lots of wonderful insights. All right, coming up, of course, before we start off our next session, don't forget to scan the QR code on the screen. You can take out your mobile phones and just do a scan. And of course, we look forward to seeing all your questions. For those of you who are standing over there at the back, there are actually some empty seats in the front, 2 rows over here. You can come on in and grab a seat, right? Over here, I see 2 chairs. I think there's another 2 over there and over there as well. So there's actually some space. You don't have to stand all the way to the back. You can come on into the front and grab a seat. Now, ladies and gentlemen, on each table, you should see the state of climate tech. Is that there? Does everybody have that? The state of climate tech on your table? If you do, just give it a wave. Everybody has that? That, of course, is the State of Climate Tech Southeast Asia 2024 report. Now, of course, this insightful publication serves as an excellent foundation for the upcoming panel discussion as well. So be sure to take a moment to read it. Absolutely wonderful. And of course, coming up, we are going to be diving into a topic that's called Balancing Impact and Alpha in Climate and ESG Investments. And of course, we'd now like to invite our panelists on stage. Please join me to welcome, first of all, Nakul Zavuri, partner and co-head of Climate Investment Strategy Leapfrog Investments. Winston Mandrawa, Managing Director and Head of ASEAN Affirma Capital. We also have Lisa Genasci, Managing Director, Sustainable Finance, ADM Capital. And finally, Abhishek Mittal, Partner, Aavishkaar Capital. All right, and of course, we also are welcoming on stage with us Sebastian Togelang, Founding and Managing Partner, Rigel Capital. And of course, moderating is Michelle Teo, our Senior Journalist and Managing Editor for DealStreetAsia. Michelle, over to you.
Thank you, Wayne. Hello, everybody. Thank you for staying with us this afternoon. We're very happy to be here with our panelists. So, despite how we feel in this room, global temperatures, I think, as everyone knows, reached a record high last year, after a record high as well in 2023, and this 1.5 C seems, impossible to meet. So we've all heard about the trillions of dollars that are needed to mitigate climate effects, particularly in the emerging markets. And in this, the private sector has a special role to play. And we are here with some of the top investors who represent different strategies in the sector. So, Winston Mandrawa, who is Managing Director and Head of ASEAN at private equity firm Affirma Capital. Lisa Genasci, Managing Director, Sustainable Finance at private credit firm ADM Capital. Abhishek Mittal, Partner at Aavishkaar Capital, a private capital firm focused on this sector. And Sebastian Togelang, Founding Partner at Rigel Capital, a sector-agnostic VC firm that is focused on multi-stage investments across emerging Asia. So welcome and thank you again to our panelists for this conversation on how and where they see opportunities across the energy, mobility, and agricultural sectors in South and Southeast Asia, and how transformative these investments will be or are already for economies in this region. So again, we invite you to submit your questions and ask them using the QR code whenever. And we can begin. No? In the broader context of the funding environment and geopolitical uncertainties, I think we're all very keen to understand how the return expectations in particular have evolved as the industry has evolved and are already seeing positive returns from the sector. So we can start perhaps with Lisa. Now, ADM has a climate-focused credit strategy, and the Asia Climate Smart Landscape Fund for One focuses on smaller ticket sizes. If you could take us through the thinking behind that, and where you see the gaps, and therefore where the opportunities are.
Yeah, I guess I should start by saying ADM is not Archie Daniels Midland. It's ADM Capital is Asia Debt Management, Hong Kong Limited, a Hong Kong-based private credit manager. We've been investing across Asia since '98, providing credit to SMEs non-thematically under an ESG integrated strategy. We also set up a foundation in 2006, which helped build a body of research and data around climate and the need for change in particular in the agri-food sector. We saw the opportunity to do something similar, to invest in, to do something similar to sort of the ADM Capital mainstream funds, but specifically for Indonesia, and focused on the agri-commodity sector. Why Indonesia? Indonesia has the third largest forest globally. It's the fourth or fifth largest emitter of carbon. And at the same time, about 50% of those emissions come from land use change, from forest to agriculture. And there's an absence of credit in the sector, particularly for the SME processor or mill, that mid-market company that's buying from smallholders and selling into international buyers. And on the other side, the international buyers have made net zero commitments or their own sustainability commitments and are pressing their SME producers, mills, to make change and to transition that smallholder supply chain. In Indonesia, again, 40% of palm oil, 80-90% of other commodities are produced by smallholders, so they're critical to the equation. Yet again, absence of capital, largely absence of agricultural extension services. So the question is, how do you help transition the sector? How do you act positively in a sector that's 13% of the economy and a third of the country's jobs? It's a critical sector for Indonesia. So how do you support that transition in the sector? So we built ACLF, which has 4 targets: emissions reduction, better land use management, improved livelihoods, and gender. And really the purpose was to act just in the agri-food sector, decouple agriculture production from deforestation, and achieve the targets that I've set out. But it was the opportunity that drove us, seeing again the absence of capital and the push on the other side from regulation and from consumers to see better practice in the sector.
Abhishek, coming to you, Aavishkaar itself has been focused on creating impact with its investments for some time, but in 2022 you launched a ESG first fund focused on Africa and Asia, and the investment is focused on ESG, gender equality, and climate change. If you could also take us through the opportunity set that you see.
Yeah, no, so thanks, Michelle. So we've been an impact investor 20 over years, and as most impact investors grew, right? So impact is a qualitative input where essentially you set the context. Pretty much every business is impactful. 3 years ago, when we launched ESG First Fund, ESG is a lot more. I would say it's a lot more technical concept, right? It's not just quantifiable; it's something which you can set a target for. And the opportunity for us from ESG First Fund perspective is obviously we are an emerging market manager, so we remain committed to emerging markets. With this fund, we for the first time we have gone truly global. So it's a global South fund with equal allocations to Africa, Southeast Asia, and India, which is our home ground. The second big opportunity for us is this is our first credit fund. So I actually always call it a non-equity fund. It's not a debt fund per se. We look at innovative structures where we can actually provide growth capital, flexible capital for quality businesses which are mature, have proven business models, but we essentially come in and give them the capital for what purpose they need, where the traditional sources of financing are not able to meet that need. And finally, we are SME-led, right? So the key core impact driver in our markets, job, be it in terms of job creation, be it in terms of building the nation, remain the MSMEs and SMEs. So on all those 3 frontiers, I think the need for capital is immense. The idea is to find the right opportunity, and that's where we are. So for us and for the Southeast Asia piece, so it's a $200 million fund, and with nearly 1/3 being targeted at Southeast Asia, we broadly feel that the bulk of the capital would be anchored around Indonesia and Vietnam.
So Winston, coming to you, in that sense, what are the particular sectors or technologies that you can focus on for sort of high impact, disruptive climate solutions in particular?
Thank you, Michelle. So Affirma Capital, having its origins at Standard Chartered Private Equity before the spin out in 2019, we are still a mid-market emerging markets private equity business. And hence, our approach to this is not the same as venture or early stage. A lot of the sectors we'll focus on where we start will be traditionally around energy. We can look at traditional sectors such as the renewable energies. It's probably easiest to work with. However, I think the challenges that we actually have to deal with here is that, so the way we think about the sector, I would like to look at this in terms of the strategy rather than sector. So we're not going to be looking at assets, we're looking at platforms, amalgamations of assets where we can actually have something which is both scalable and replicable, which is a business model which is sustainable. So eventually when it comes to exit, there are parties who can take this and say, hey, I can actually, the systems and processes in place that we can actually keep this growing, right? We're going to really focus on ensuring governance and institutionalizations of these. So I would like to say that for us, it's more about strategy rather than overly emphasizing on sectors, because I think that's also what the broader investment community needs in this sector, or in the climate and impact space, versus just, which sectors do I look at?
But what about you, Sebastian? I think Rigel has some very interesting portfolio companies.
Yeah, thank you. So basically when we started Rigel, we didn't have a focus on sustainability. And so we are just focusing on companies that are scalable, obviously good return possibilities. But for example, when we started investing, we've been looking at a lot of companies, and for example, last year we looked at over 100 companies. Turned out that over 70%, or actually last year we probably almost 90% of our investments are related to sustainability. So it's very interesting that actually now we realize that the sustainability sector, actually companies are becoming very interesting for us to focus, and while still focusing on good return, giving good return for our investors.
Are there particular sectors?
Oh, yeah. So the sectors that we invested, we invested in air quality optimizer. We invested in organic fertilizer company. We also invested in electric vehicles. What else? We invested in metal recycling company. And then also we digitized a lot of SMEs, optimizing also a supply chain. So a lot of relation to sustainability and ESG.
Look, but coming back to you, Winston, actually, if you look at this, what are some of the biggest barriers that you see to investing in this sector?
Look, I think many of you have attended these conferences and the broader DealStreetAsia conferences over the years. And generally speaking, I think there's a lot of there is a lot of bullishness for various sectors as they come and go. But there is an underlying theme that just investing in the region is not straightforward or easy, right? You've got 600-700 million population, but sitting across effectively 10 different countries, different regulations, etc. So now, as you delve into a space where you're looking at climate and impact, what is it that makes this difficult? Well, you've got the underlying difficulty of investing in the region in the first place. But what we do see are the gaps. There is talent. So if talent is already difficult, then you start narrowing the constraints that you actually want around them. Talent's the issue. I'm sure there'll be discussions on regulation, but aside from that, then you have to say, well, hang on, do they have the experience and knowledge to actually navigate not just the existing conditions, but what the evolution becomes through. And then there's broader governance as well within this. especially it can be a matter of who you know, how you actually make things happen. But then we have to ensure that the companies that we look at, that we invest in, that we screen, they have the appropriate governance processes in place. And then there's a broader capital universe. So if you imagine you're doing, for us, I'll take it back to renewable energy, you are trying to get involved in greenfield projects. Is capital available? And not just is capital available, but banks themselves, they will lend, but they have their own processes, procedures in place, criteria, and is that necessarily appropriate? It actually provides a fantastic opportunity for the likes of Lisa here to actually come through. My only flip side to that is, because that's still evolving, it's not standard. So there isn't, unlike when we're talking about broader M&A where you say, hey, this is market standard, we actually don't have a market standard, which means it's quite a lot of work for us.
Thanks. So coming to you, Lisa and Abhishek, if we were to take sort of a broader view on the sort of barriers to investment or what can affect investment decisions, policy changes or commitments, how do you see that?
I'd just like to pick up on one point that Sebastian made earlier, though, which I think is a really good one for this conversation, is that they start out just investing in good companies, and they happen to be sustainable. And I think that has to be the theme here. We're investing in companies, yes, under an ESG integrated strategy, and there's a lot of noise around ESG, but in the end, these are just good companies that we're investing in. And if they're not, sustainable, we can all, I think we're all focused on trying to make them into better companies to withstand climate shock or just be resilient. So I think that was an interesting point to bring out. But in terms of the regulatory environment changes that we're seeing, I mean, of course, as climate challenges become more evident, and we all recognize that soil is degrading, water is less resistant or less absorptive of water, our forests are depleting. There is noise, obviously, from consumers and certainly from the EU around climate and regulation. We definitely feel that there is, despite the sort of counter noise, perhaps from the US around ESG and climate, that the reality is the change is real. Most people see that. We're working with entrepreneurs, families, businesses who see the change. We're working with smallholders who see the change, and they want solutions. They want to be able to understand how they can protect their watershed. They want to be able to produce their product. But there hasn't been enough support to help to aid that transition. So huge opportunity, regulatory push will come in the future, hopefully, but we just feel that really that's inevitable.
As Lisa said, I've been working for 20 years. In the last 10 years, only thing I've learned about regulation is you can't time it. Right? So, by the time you raise a fund and by the time you exit the fund, the regulations could be entirely different. So the idea is to, if you're lucky, you'll get a regulation that becomes a tailwind. If you're unlucky, it'll become a headwind. You cannot build a strategy out regulation. So the key remains to find a business which has a product which people are willing to buy. And that's where Lisa hit the right. We are going with the mega trend of sustainability because we believe that's where the consumer is moving. The consumer is willing to spend more, or at least willing to buy more of a sustainably produced product. Irrespective of whether the government is pushing towards sustainability or going anti-sustainability, I don't think anybody in this room would deny that, if you could get the same product produced at the right price and is available and is the right quality, which is most sustainable, we'll all choose to buy a sustainable product. And that's where, finding the right companies are. So, we tend to focus more on the consumption or the story or the product rather than, whether regulation is helping it. And then, for lack of a better word, pray that the regulation is on your side when you're looking to exit the business.
Yeah. So that leads us very well into the next section. We're going to talk about value creation. How do the strategies that you bring, whether it's in late stage funding or earlier stage funding or even private credit strategies, how do you help portfolio companies sort of meet both the financial and impact goals? Maybe Abhishek and Lisa, we can start with you again.
Yeah, I mean, obviously we are providing the benefit of private credit in this sector, where bank capital is shorter tenor generally and often absent because of this perceived risk in the sector for agriculture, for financing agriculture, with the exception of potentially palm oil, which is just considered a higher value and more secure product. Private credit can be nimble. We can back end our coupons. We have strategies to be able to be flexible, basically, for our companies that we're working with. So it is an appropriate vehicle, I think, for the sector, and the tenor is longer. The ticket size, as you mentioned in your introduction, for Asia Climate Smart Landscape Fund, our most recent fund, is smaller than an average ADM capital size. So it's appropriate for the sector and for the SME investor that we're looking at. So we form at the same time we believe very strongly in being partners with our companies and carrying forward, not just making sure that they're, again, back to the earlier point, they're strong in terms of credit and finance, but also they're strong in terms of sustainability. For us, that makes a good company. So we can be a partner with our borrowers on both sides, both on the credit side and on the sustainability side. And we work closely with other partners, experts in the sector. We can layer in support from hopefully local government where that's relevant, or academia where that's relevant in terms of monitoring, evaluation, providing support directly to the company itself. The objective is to bring that expertise to our companies and provide, when necessary, some grant funding also to build in the cost of transition, because that is expensive. An important part of this transition is going to be technology, which is in abundance elsewhere globally, I think, and still somewhat absent in Southeast Asia in the agri-food sector. So there's a lot to do, there's a lot of potential, a lot of opportunity, but that's expensive. So being able to, again, work with our borrowers to help them build in what's relevant from elsewhere and develop a sustainable product, we think is a sweet spot for us.
See, with no offense to our brethren, I always felt that the claim of the private capital industry to add value to business is overstated, right? So we can provide capital, we can provide you flexible capital, and that's where it ends. I often have argument with many founders who come and say, okay, I have capital from other sources, what are the value add you can do? At best, I can connect to your network. But I completely, align with what Lisa said, right? It's monitoring, working on the impact side, essentially putting a lot of the systems and processes in place, especially for SMEs, is an expensive task, right? So just of our fund, right, we have a TA facility, a 2 million, typically end up extending a lot of support and help, which is free grant money to our portfolio companies. All we expect them is certain skin in the game, right? We generally want them to, if it's like a $50,000 project, we want them to fund 25% of it so that, because I've realized free advice is treated the way it is. So we generally end up getting them to put some skin in the game, but that helps them, to bring in that consultant, bring in that external support that they sometimes, which, in their capital is simply not available. So that's one value. And secondly, obviously, once you are in accepted institutional capital, it helps you, we get you access to a market, get you access to a network. And quite often, it makes you more attractive to not just other investors, maybe the buyers and other things. So that's limited what we see.
This might be a good time to take one of the questions from the audience that's come in. How can climate investments wean itself off impact capital and become truly market-driven? To that end, do we...
Yeah, I think we're getting there, as I think we've all said. We are in this moment of transition, right? And there's no level playing field. So we need, at the moment, to provide support to those first movers to make that transition and to implement better practice, make sure the standards are international standards so that they are an attractive product for buyers. And I think our borrowers are seeing the need to be that first mover and that attractive player for their buyers. But it will come with regulation. It'll come with more push from abroad. Another thing that I have to mention is we talk a lot about premium price for sustainable product. I don't know why we've stopped talking about the true cost of production instead. Let's talk about the real cost of a product that's not produced sustainably and sort of flip that equation entirely so we don't have to discuss who's going to pay the cost of the premium price. Let's talk about the real price of production.
Abhishek?
No, so see, we have firmly believed as a firm that, impact investing and mainstream investing are pretty much now the same, right? Most mainstream funds today would claim to be an impact investor, and as an impact investor, we compete with mainstream investing all the time. I think that distinction is pretty much gone. We have the same structures in terms of, what our composition is aligned it, and we essentially looking for the same transactions. And as Lisa said, we're all looking for good companies. So, it's not that, I would fund a bad company simply because I'm an impact investor, right? So, as Sebastian himself said, these are good companies which happen to be sustainable. But if there are one space in which you see if there is a very bespoke mandate, right, something which is very niche, there we are seeing is that, there is a requirement for what we call catalytical capital, which, the expectation is, a 5 to 7 years that sector or that need or that mandate would become part of mainstream, right? For example, something like a circularity. At Aavishkaar, ESG First Fund started as one such, right? It's a blended finance structure with our core LP providing first loss structure and a pretty long tenure, which allows us to raise capital and make sure that, within first 5 years, we'll be able to start bringing in commercial capital, which automatically makes it a return-driven capital. We're currently working with another very interesting mandate around circularity, where, circularity in the garment industry. So a lot of those for very bespoke mandates, you need an initial 5-7 years kind of blended finance structures, which helps bring in commercial capital. But in the end, for any capital product to be viable, it has to be, you cannot distinguish between that this was an impact investment versus a mainstream investment.
Yeah, I mean, our objective would be to exactly that, is to transition our companies to better practice, and we have a good exit, they transition to cheaper capital.
Right.
100%.
Right. I mean, just picking up on that. Yeah, Sebastian, yeah.
So yeah, I mean, also selection is also important, right? So as mentioned, we have been looking at a lot of companies, and at the end we find out there are actually companies that are now, the sustainable solution are more efficient than the traditional solutions. So just for example, our electric vehicles now are priced below the traditional ICE bikes, and we actually can give a saving of more than 50% to the end customers if they switch from ICE to EV. Our organic fertilizer that we invested, because of their technology and production, they can produce in a very cost-efficient way that they become actually, we can sell it below the chemical fertilizer. So while it's actually improving the crop and the soil and obviously building good environment. So there are good products and entrepreneurs that are committed to sustainability that we can work with. So this is something that, luckily now the time is right for sustainable investment. We're seeing actually the performance of the climate tech funds has been above 25% the last couple of years, actually beating the traditional VCs. So actually the time has been changing. And I think there's more and more need for investment and look at all the things that are happening in the world, burnings and floodings and everything. So I think it's for us now to put in more energy in that.
Right. So ultimately it is already beginning to be market driven. That's what we're saying, no? So not so much based on grants, as it were. But I was just wondering, coming to you, Winston, whether you thought the fund structure, the tenure, is really the best vehicle for such investments.
Look, this is a difficult one because I think we need more time and track record before we can actually make that call. But let me talk about some of the difficulties we would actually say with fund structure. I think one is more so the fact that, and Patrick alluded to it this morning, it's better to be someone who wants the capital rather than a provider of capital. So you get the fund structure we actually have to deploy. And I mean, I think when we list to Abhishek as well as Lisa, you know, their fund sizes have also been have adapted for the space. So is the fund, I think the first thing is ensuring that there's sufficient opportunities, right? The other thing is, well, and I put yourself in my shoes where I'm looking at the energy transition space. We're looking to build out platforms. So it's not just going to be the upfront investment and we're waiting for the business to actually deliver. There's going to be more capital which is actually going to be required over time. And as we roll that out, do we actually need longer periods? The good thing about a fund structure, there is a structure in place. You can adjust terms. I think what's more important here, though, is the broader ecosystem developing, such as if you need an extension, do you actually have, you know, is there an ecosystem of capital who could actually jump into continuation funds, or others who could actually take over other like secondary transactions which would actually replace LPs if they wanted out. So what we're actually saying at the moment, we're looking at, for this space, we're looking at individual platforms we're building on a deal-by-deal basis. And what also is the case is that the LPs which are coming behind that are not necessarily, they're a narrower set where we're seeing the sovereigns, the DFIs, and hence we're actually able to be quite bespoke with respect to the SPVs and the arrangements for this. So I'm not going to say there's a problem yet at the moment. I think it's more so the fact that we haven't had enough time and track record. And that actually goes back to the question which had been asked earlier. Fundamentally, what we just need is a track record of commercial outcomes, and effectively, we just need time for this to actually play out for the broader market to not just accept, but to actually benefit from, you know, investments as a whole. And this sector is just, you know, a subsector of the broader investment universe.
Yeah. So where are we, you know, in this sort of virtuous circle of trying to attract more capital with hopefully more positive returns in returns and returns expectations, you know? If Sebastian and Lisa and Abhishek want to take that question.
Yeah, so for us, as mentioned, I think there's a transition now where 10 years ago, I think sustainability was where everybody is thinking of, okay, this is a long-term investment, it's going to take more time, it's going to burn, or a lot of grants is needed. I think we are coming to a transition where now sustainability solutions actually surpass from the efficiency and getting more and more important. And obviously with the change of the focus of the world, I think most of the governments now also really have the pressure to invest in sustainability. So I think this is a very good transition where we believe in the next years, actually the sustainability investment will be increasing. There will be a lot of adjustment. There will be a lot of good friends like providing alternative investment or also credit, good financing models to support maybe also a bit longer term sustainable investment. Governments will adapt with programs that support that. So I think it's a good direction. World Bank itself said there's at least 20 trillion needed by 2030 to invest it in sustainability to achieve the climate goals. So we're still far away. So I think the world is aligned to work on this problem.
Yeah.
Just to echo what Sebastian said, I think on the demand side, there's no issue. You know, the capital need is very real for the sustainability. Purely from a credit perspective, the short-term challenges would remain like, you know, high interest rates make it a little difficult for us to attract, you know, capital towards private credit for emerging markets. But I think this is something which is, we are past the curve. Interest rates are expected to be. And plus, whatever noise you keep hearing on the regulation side, I actually won't be surprised that, 2025 would be, a very high volume and a high transaction for the climate finance, despite all the noise that's happening.
Yeah. Speaking of noise, not that the question is noise, but there's a question from the audience. Hopefully we can answer it. How will the incoming Trump administration or Trump's leadership reshape global dynamics of sustainable investment, if at all? Maybe Lisa?
Thanks. Although I think I mentioned earlier that I felt there was, obviously there's a lot of noise around ESG and climate. That's part of the bravura, I think, in the US at the moment. Obviously there's a favorable consideration of oil and gas, there's no question, and EVs and not EVs. You have Elon Musk leading the charge on EVs, so he's there to make sure that EVs remain top of mind, I think. But renewable energy is loudly, at least at the sort of the conversational level, less at the front of people's minds, perhaps. But I, like my colleagues on the panel, believe firmly that that doesn't reflect the reality, what's happening on the ground, the fires, the droughts, you know, the excessive rainfall, heat. I mean, we're all feeling it. Everybody is feeling the impact of climate. So I think people who are involved in production really understand the need for change, and that's not going away. We're feeling that there is an urgency from borrowers and from companies to implement new practices and to figure that piece out.
And the age of AI is happening, right? So technologies will develop much faster now. There are new technologies coming every day in multiple sectors. So I think that a certain administration cannot change that, and I think this will influence all the tech development moving forward. So yeah.
Right. So we'll take the last couple of minutes for rapid fire. So Abhishek, you already shared your 2025 boom in demand for private credit. But Winston, from you, what do you think 2025? What's your top prediction for the year in this sector?
Yeah, I think we'll see a lot more of your DFIs, your sovereigns, especially in this region. They're already getting involved, but I think we'll see their name in headlines a lot more prominently throughout 2025.
Lisa?
Yeah, I'm hoping that we'll see agri-food take that step towards harnessing technology to align with nature rather than depleting nature. I'm very excited about the technology that we're seeing broadly in the agri space, and that would produce an agri product that's, you know, biodiverse, dynamic, adaptive, and resilient.
Sebastian.
Yeah, coming back to the point that now everything is more AI data driven, so transparency is going to be more required. There are a lot of the new technologies will be more measurable. And obviously because of the development of AI, there will be so many new technologies that gonna be influenced also with data and data processing. So I think that and since also the global situation and the push, what I mentioned earlier, I think there's a good growth in the sector in combination with new technologies.
If I make one more, I think most likely Trump and Musk would have a fallout within 2025. So.
Okay, here's hoping. So thank you to our panelists. So in short, it seems that we are further along than we have expected, we would have thought, towards the climate investment virtuous circle, as it were. So thank you again for joining us this afternoon, and thank you again to everyone for sticking with us.
Thank you so much for that engaging discussion. Let's have a photo of our panelists before we go. All right. Do you want them to come in front of the tables? Yes, should you just step in front of the tables? How does it look? Let's see. Yep. Yes, closer a little bit. Yep. Ah, There we go. All right, big smiles to the camera. Now, of course, ladies and gentlemen, as that's going on, just want to let you know that we're going to be having 2 fantastic luncheon sessions lined up for you right now. Don't go anywhere because you're going to want to know where these are. They're both happening at the same time. So take your pick at Newport 1. Both of them are on this same level, right? It's B1 where we are on this level right now. One of them will be at Newport 1. That's the first room. And it's sponsored by the HKX, or Hong Kong Stock Exchange. And we'll be going into connecting Southeast Asian firms with global capital in Hong Kong as the IPO window reopens in 2025. Opportunities and perspectives will dive into what the future holds for Southeast Asia's IPO market and how Hong Kong is gearing up to be the go-to destination. That is happening at Newport 1, sponsored by the Hong Kong Stock Exchange, or HKX, at Newport 2. Listen up for this. At Newport 2, also on this level, we are at B1. This session is sponsored by Cento. And what is Cento bringing us? Well, we'll be talking about Digital Indonesia. Uninvestable no more. We'll explore how the recent market reset has opened up new possibilities in Indonesia's digital economy and made it a hotspot for investment. So if you're interested in that, head on over to Newport 2 to listen in to Digital Indonesia, Uninvestable no more. And of course, that luncheon session is sponsored by our friends from Cento. Thank you so much, Cento, as well, for the kind sponsorship. Now, both sessions are going to be going on right now. So head on over to either Newport 1, where you can listen into the Connecting Southeast Asian Firms with Global Capital in Hong Kong as the IPO window opens or reopens in 2025. Opportunities and perspectives. That's sponsored by HKX, or Hong Kong Stock Exchange, happening at Newport 1. In Newport 2, you should head on over there. That's a session sponsored by Cento, and we'll be discussing Digital Indonesia, Uninvestable no more, exploring the recent market reset. And of course, that's sponsored by Cento. Head on over to Newport 2 if you're interested in discussing that topic. Now, of course, at the same time, some other announcements, quick ones. Of course, feel free to approach our information desk located next to the registration if you're interested in learning more about our DealStreetAsia editorial products and upcoming events. Be sure to check out DFin, one of our sponsors and a leader in innovative tech-driven financial, regulatory and compliance solutions. Stop by their booth and have a chat. You won't want to miss the discussion with him. We also have the FT Professional booth with us today. If you're looking to stay ahead in the 2025 market outlook or explore exclusive special reports like the future of AI, their team would be happy to share how their content can benefit you. Now, here's a tip. You might even snag some cool FT Pro swag while supplies last. And don't miss Art Hotel, a unique arts and premium lifestyle hotel that goes beyond just decor. Art Hotel invites you to create, interact, and immerse yourself in original artwork. Swing by their booth to learn more about this incredible concept. Now, of course, I want to say a big thank you to some of our partners for supporting us. Thank you to AC Venture for the Lanyard sponsorship. And also thank you to Google Cloud that sponsored the Startup Tech Passes. We also want to thank Aavishkaar Capital for sponsoring the ESG passes. And of course, thanking our media partner, Nikkei Asia. And of course, thanking our friends from DFin. DFin sponsored the pre-summit networking event. We hope you enjoyed that. And of course, our supporting partners, without whom this won't be possible. And they are Northstar, Affirma Capital, Warburg Pincus, FT Professional, Artatel Group, HKX or Hong Kong Stock Exchange, and Responsible VC. Now we'll see everybody back here in this room. What time? 1:50 p.m. 150. We'll see you back here at 1:50 p.m.